Welcome to This Explainer. Today, we are diving right into the massive, often totally unseen geopolitical shifts that are literally rewiring our world. We're talking about everything from the very real vulnerabilities of the US dollar to the absolutely fierce battle over the physical materials that power our modern economy. So, if you want to understand the real chess match happening just behind the global headlines, well, you are definitely in the right place.
Here is a quick look at our roadmap for today. We'll be running through the dollar under threat, fiat and the petrodollar, China's supply chain chokehold, securing critical minerals, and then we'll wrap up with investing in global shifts.
All right, let's jump straight into Section 1, the dollar under threat.
To really understand the risk to the global reserve currency, we kind of have to look at recent history through a strictly economic lens. When you neutrally observe recent geopolitical events, from the sweeping global tariffs of 2025 to the capture of the Venezuelan president in 2026, all the way to the ongoing disruptions in the Middle East, a pretty distinct pattern emerges. Whether it's intercepting oil destined for Asia or totally restructuring trade agreements, the underlying strategy points to a much larger global economic competition, and specifically, a competition with China.
Now, the core concern for the United States isn't just political here. It is deeply, deeply economic. Projections consistently show China on track to become the largest single economy on Earth. In fact, their actual physical production power has already surpassed the U.S. Add to that the fact that the BRICS alliance is increasingly adopting the Chinese yuan for their currency reserves, and well, you start to see the issue. As China's economy outgrows the U.S., the yuan could eventually threaten the absolute dominance of the U.S. dollar.
Moving on to Section 2, fiat and the petrodollar. Let's unpack the actual power of U.S. currency.
To really grasp what losing that reserve status actually means, we need to quickly define what gives the dollar its power today. Back in 1971, the U.S. moved off the gold standard. Why? Basically because the sheer scarcity of physical gold was capping GDP growth. The economy literally couldn't grow faster than we could pull gold out of the ground. This shift turned the dollar into a fiat currency. So today's dollar relies entirely on the economic strength and the overarching power of the United States. Its value comes entirely from the world's trust in the U.S. economy. But trust alone isn't enough, right? You need utility. Enter the petrodollar. Established in 1974 through agreements with Saudi Arabia, this system ensured that global oil transactions were priced and sold exclusively in U.S. dollars. This forced countries all over the world to hold dollars just to buy energy. Now, this petrodollar system has historically protected the U.S. from hyperinflation by ensuring there's just a constant global demand for the currency. But recent shifts, like Saudi Arabia beginning to actually sell oil in the Chinese yuan, are threatening to erode that foundational power. But here's a totally fascinating twist to this currency war that really builds our understanding of digital currency. While the traditional physical dollar faces threats from the yuan, digital stablecoins, which are largely pegged one-to-one to the US dollar, are actually expanding US economic influence. Across developing regions in South America and sub-Saharan Africa, where traditional banking infrastructure is pretty sparse, everyday people are heavily adopting these dollar-pegged stablecoins for daily transactions. So ironically, these areas are essentially becoming US dollar economies without even realizing it.
Let's shift gears to Section 3, China's supply chain chokehold.
While the United States has been focusing heavily on maintaining this currency dominance, China has taken a completely different and very physical approach. There's a massive philosophical divide between the two superpowers here. The U.S. strategy prioritizes currency access and maximizing the global purchasing power of the dollar. It's all about trade notes. The China strategy, however, is heavily asset-based. They are prioritizing absolute value, physical commodities, and monopolizing the global supply chains of the things you actually buy. Basically, the U.S. wants to control the currency you use to buy things, while China wants to control the actual things you need to buy.
So, how far are they willing to go to control those physical assets? Well, $10,000 a ton. To maintain control over global markets, China utilized a coordinated state-level strategy to intentionally crash the price of lithium. In a very short period, they flooded the market with their strategic reserves, driving the price of lithium carbonate from around $80,000 all the way down to under $10,000 a ton.
Now you might be wondering, why take such massive financial losses? Well, by crashing the price, new mining operations around the world suddenly became unprofitable and had to shut down because they simply couldn't find funding. It's exactly like a rideshare app taking massive losses to bankrupt traditional taxi competitors. China absorbed huge financial hits just to starve out the competition. Once the competitors folded, the prices could creep back up. And the result? China successfully maintained an 80% chokehold on global lithium processing.
Which brings us to Section 4, Securing Critical Minerals. This monopolization of the physical supply chain isn't just some abstract economic issue. It has truly terrifying implications for national defense and technology. Listen to this quote from a retired Department of Defense admiral at a 2025 congressional summit in D.C. Quote, "We have things that go into missiles where 100% of the supply chain is Chinese-controlled, and they didn't even think to look. That's wild. The United States government is just now doing self-inventories and realizing that absolutely vital radar systems, naval boats, and guided missiles are entirely dependent on adversarial nations for their raw materials." And the crucial point to remember is that this isn't just about the military. Our entire commercial technology ecosystem is totally reliant on these exact same vulnerable metals. The very foundation of the modern economy. We're talking about the batteries in electric vehicles, the chips inside iPhones, the massive data centers required to run AI technology like ChatGPT. They all require copper, neodymium, lithium, and rare earths.
To protect domestic companies from being completely wiped out by China's price-crashing tactics, the U.S. has been forced to take some serious defensive economic actions. They are drafting congressional acts to establish critical mineral price floors, essentially setting a minimum price just to keep domestic mines profitable. The U.S. government is even directly purchasing equity in rare earth processing companies, really scrambling to nearshore and restart mines right here in the U.S. and up in Canada.
Okay, final part, Section 5, Investing in Global Shifts.
We've covered a lot of intense ground today. So how do we reframe these scary macroeconomic vulnerabilities into actionable strategies? Look, when you read the news, these macroeconomic shifts and geopolitical conflicts naturally generate a ton of emotion. Fear, anger, excitement. But for the informed, long-term researcher, they generate something else entirely: investment opportunity. Anytime global money and massive supply chains are forced to rapidly change direction to secure national interests, absolutely incredible long-term investment opportunities are created for those who are paying attention and looking ahead.
The methodology behind actually identifying those opportunities is fascinating. As outlined by institutional researchers, true long-term investing isn't about blind luck. It's a rigorous three-step thesis. First, you identify the macro trends, like the major shift away from Chinese reliance. Second, you dive into white papers and literally go talk to the scientists and experts on the ground. Finally, you layer in the heavy finance, the risk modeling, and setting 10 to 15-year price targets. You really have to ask yourself, what materials, like magnesium or neodymium, are going to be absolutely essential in the economy of 2035?
And this right here exposes the massive gap between amateur and professional investing. The retail approach reacts to internet hype and relies heavily on historical data averages. Frankly, Wall Street often uses this too, entirely missing the fact that a commodity is worth way more in today's tech-heavy economy than it was a decade ago. But the professional edge? That comes from identifying the shift early, projecting forward, and physically going to events like the World Mining Congress in Peru to talk directly to the executives who are actually pulling the metal out of the earth.
Ultimately, all of this research points to one glaring conclusion. Energy is the true currency of the future. Whether we're talking about the traditional petrodollar anchored in the Middle East or the new energy paradigm of lithium and rare earths controlled by China, the nation that successfully secures the global energy supply chain fundamentally secures the future of their economy. Which leaves us with this final thought. As the United States and China navigate this massive economic Cold War, completely rewiring global supply chains and battling over reserve currency status, the absolute biggest question for you, the informed learner, is this. Who do you believe will control the flow of energy in the economy of tomorrow, and how will you position yourself to ride that wave?